As Kathy mentioned, my name is Doug Gross. I'm a CPA with Ledyard Financial Advisors, and Ledyard Financial Advisors is a division of Ledyard National Bank. We do wealth management, we do financial tax planning, and as well as investment management, portfolio management. And today, I just wanted to talk about a couple of things. One is saving taxes generally, and what you can do at year end to maybe save some tax dollars. And the other thing I'm going to talk about is dealing with your CPA or dealing with your accountant during tax season. Not all CPAs are as personable as my friend Virginia. Some are more grumpy like me. And so if you call us on March 20th, hopefully, you can get somebody with Ginny's disposition. We can be a little grumpy on March 20th. And so what I want to talk about today is what you can do in November, December, in January to make the relationship with your tax preparer go smooth. One thing I don't like to see when I sign a return is a surprise at the end of the return. This client owes $6,000. I thought they were going to owe $500 like they did last year. So one of the things that I really try to do is get an idea of what the client's tax return is going to look like before I even see the materials. This means I want to meet with them in November or December, and I want to avoid these client concerns that I might get a call in March saying, Doug, where's my return? I dropped it off on March 20th. They call me on the 25th, and at that point, our real busy season, our tax season, is incredibly busy that last month. March 15th to April 15th, we can be difficult to reach. So if you're dropping off your return on March 20th, you're not going to see it on March 22nd. So the earlier you get it in, the better. Another question I see is, why don't I see certain deductions on my return? A couple of these, if you rent part of your home out as an apartment and you're looking for the property tax deduction, it might be split between two different schedules. Chances are it's there. Just maybe talk about meet with your preparer in December or November and go over the prior year return. You can if you look at the prior year return before, like this is a great time to review your 2014 return. If you have any questions about that, and if you're using the same preparer, raise those questions with your preparer at this time of year. One of the other things that I've heard the last few years is the cost of preparing tax returns have gone up. The IRS has required more and more disclosures. We are under more and more obligations to investigate certain client data. There's more of a burden on us. There's more reporting. So it's unfortunately the cost of tax prep, and at least for the financial advisors, I think we've raised fees twice in the last 7 years. When we do raise them, we do get some concerns. But just keep in mind that the IRS is requiring more and more of your tax preparer. The forms are getting thicker and thicker, as you probably know, and there's more work. It's not, some people have this conception that all I have to do is get these numbers to my accountant, they just drop in the software and boom, it's done. Unfortunately, it's not quite that simple. When I have a new client that came from, either a self-prepared return or a chain tax prep service, they might pay $250 for a very simple return, and a CPA might charge $350. I think the cost is justified. I strongly encourage you to use a local CPA, someone that's going to be there in May or June or August if you get a notice, someone that's going to answer the phone. So there are places, there are national chains that will do your return cheaper. I would strongly recommend that unless it's a very simple return, I suggest you find a tax preparer or CPA in the area.
So Doug, my husband and I have a complicated form, and so we actually don't mind paying for that because it's two businesses, it's a bunch of stuff. But what for the kids we found in New London anyway is that the AARP runs a really great free service, as the kids aren't earning it. Well, hopefully someday they'll be earning it. But for now, or for elderly, like for parents, and for simple returns, they're not charging anything, and it's online, and they do good counseling. So that would at least get you. And most good CPAs don't really want to do the kids' returns because they get that kind of pushback on the $100.
That's a good point. Yeah, I've seen returns prepared by Upper Valley Senior Center, I think it is, and they do a great job. The one thing you want to be careful of, though, is the kid's return. If the kid has investment income,
That's a dip, yeah.
he's required, or here, the child is required to, you have to know what the parent's taxable income is, because there's something called a kiddie tax. So if the child has investment income over, I think, $1,000, you need to know what the parents, so it's not just taken, you can't just really take the kid's 1099 from Ledyard to, you know, a chain or a free service and expect an accurate return, because that, the parent's information has to be incorporated into the child's return. So that's why when, you know, I have had a couple of questions from clients over the last 7 years that I've been at Ledyard, you know, why did you charge me $150 for my child's return? That's it. It's not just dumping in the kids' summer wages. It can be more complicated than that. Not to kvetch too much, but Deborah knows I don't like to complain. My assistant's Deborah Curtis, who keeps me sane during tax season.
You could tell us later.
Sometimes I do complain. If I'm trying to reach a client, there's like one little piece of information. If I just need to talk to the client for 30 seconds on March 20th so I can get the return out, and I find out the client's out of town for 2 weeks, or Deborah tells me, oh, we got a call from, you know, Mr. and Mrs. Johnson, they're in Australia, and I didn't know that. It's going to slow down the process. And my thoughts are, if the sooner you get your return, the sooner you get the information into your accountant, and I ask for it by March 15th. It's not always possible, but if you can get 90 to 95% of your materials to your accountant by March 15th, my guess would be that your fee that you're going to pay him or her to do tax prep is going to be cheaper than if you turn it in April 1st. So don't wait for that last K1. You know, if you can get 90% of it into your account by March 1st or March 15th, that would be great. Again, the last month is critical. I mean, I'm not sure what Virginia's practice is like, but, you know, I'll have, you know, 40 files that are open, 40 client files that are open during the day in my office. I'm working on 40 returns pretty much every day from March 15th to April 14th. And then the last thing about getting the returns filed is we do electronic filing. Even in New Hampshire, we have electronic filing now. It only took a few years, but New Hampshire's on board, the feds are on board, the states are on board. So what you need to do is when you get the tax return back, your accountant probably has included a letter saying, sign this form, get it back to us, and then we can file the taxes. The tax return's not filed when you get the packet in the mail with the return. Some of the things we've talked about, this is a great time of year to meet with your accountant, talk about last year's return, what's going on this year. If you're unhappy with what your accountant did for you last year, this is a great time to shop around. Your client, if you're interviewing client or interviewing CPAs over the phone, they might ask you what your tax bracket is, what your effective rate is. You should know those. That'd be very helpful to get off on the right foot with the new accountant. Organization, it's the one thing that we really rely on you folks for. Most firms, ours, myself included, we send out tax organizers, which are booklets that incorporate last year's information. We send those out to you in January. It says, hey, answer these questions. Let us know if you made, any large charitable acknowledgments. Attach the documentation from the charities. Please give us all your 1099s. And the good thing to do is to talk with your accountant in this time of year or in December. And you should have your own idea of, is your current year income from your business higher or lower than last year? You should know that. So if you know that your income is going to be higher this year, you're probably going to pay higher taxes. And so when you get the return, you won't, if you haven't talked a lot about your situation with your accountant, if you know your income's higher and everything else is equal, your tax bill is going to be higher. Let your accountant know of any unusual expenses for the year. Medical expenses, they have to be, significant. If your medical expenses are, say, 10% of your monthly income, you probably are going to have a deduction. So it has to be a significant medical expense. Moving expenses for jobs is a change of life that can be deductible. Flood damage could could create a tax deduction. We also want to know about any unusual income. While inheritances aren't taxable, the investments that you got, or the investment income that was generated by the inheritance would be taxable. Did you win the lottery? Did you win a raffle? A client won a DPR raffle a couple years ago, and DPR issued a 1099, and that gift or that winning was taxable. So look for anything that says important tax information or 1099, give that to your tax preparer. Let your client or let your accountant know if you've got married, divorced, any births or deaths in your immediate family. And what we need to do, what I'm trying to do, is I try to touch base with every client in either November or December. Find out if they had any concerns about last year's, not only the actual what tax return looked like, but if they had problems with our fees. This is a great time to talk about that. One of the big things we need to know is if we called for you to pay estimated taxes last year, did you pay those? That's one of the things that we don't want to chase down. We should know that. It should be pretty easy to find. So we want to lock in estimated taxes before we even look at your materials in February or March. And one thing we'll ask you is, did your business generate profit to create a taxable situation? And if so, is there cash in the bank account to support a post-1231 deduction? And Ginny will talk more about post-1231 deductions, but basically contributions to a retirement plan. If you make those by April 15th, the following year you can deduct them for 2015. So this is what we want to do. We just want to avoid any surprises. My goal is, if a client, I touch base with the clients quarterly, so I know what their investments have done at Ledger. I find out if there's any significant changes of life in terms of marriage, divorce, things like that, severe illness. And what I want to do is just plan, get an idea of what the client's going to owe or have coming back by the end of the year, because we don't want surprises. So what I shoot for is either a refund or owing the IRS, within $1,000 either way is a pretty good target that I like to use. And bottom line is communication with your preparer. Talk early, talk in November, talk in December. January is not too bad either for a lot of us. I meet with a lot of clients in January, and we just want to avoid surprises, and especially that last month of the year. And yeah.
Oh, I'm sorry.
No, go ahead.
Could you just comment on your professional feeling about paying by the 15th of April or late filings?
I really don't want a client to pay after April 15th. I mean, sometimes there's no.
No, I'm talking about filings, not payments.
Oh, whether it's appropriate to extend the return.
Right.
When I first started at Tyler Sims, the theory was that we heard, and that a lot of clients pointed out to, or one client in particular pointed out to us, is he had read all these studies and concluded that the IRS is less likely to audit you if you file an extension. That was in the late 90s, early 2000s. Whether the IRS will deny that. That was just a matter of the IRS will publish guidelines of how many returns have been audited, and then tell you, how many were extended. I don't think they provide that information anymore, but that was the old rule. I extend if we need to extend. If a K1's going to come to me on April 10th, we're extending. So I don't extend for strategic purposes.
But it's not, I guess the question is it bad or good? Does the IRS care one way or the other?
I don't believe so. They'll tell you they don't care, because they're going to get their money April 15th.
Just going to say we always do, just because we're so unorganized a lot of times.
Yep.
It worked in our favor this year because with the Anthem breach, someone tried to defile our taxes. So,
Oh, interesting.
So you had filed your extension before someone tried to file a return?
yes, but we also need to do it on the breach.
Yeah. And with that, I wanted to introduce Virginia McGrody. She is a partner at Tyler Sims and St. Severa, which is right across the street, and it's where I got my start in this wonderful profession in 1997. And Virginia was very patient with me, taught me a lot, and I'm so glad to have her here today.
I've never been so geared up before. Well, that's funny because I can't really hear it, but you can? Okay. Thank you. Thank you for having me here today. I'm usually stuck behind a desk no matter what time of year it is, so it's actually very nice to get out and see a lot of people, which is terrific. I'm picking up the presentation from the business side. At Tyler Simpson Sainsbury, we do a lot of business returns. I do a lot of business returns, and we just had a meeting, a staff meeting for our tax department just the other day about, gee, what can we do to get the business tax process moving now? Because if you think about it, the business returns are usually the first returns to go out the door. We're not waiting for Morgan Stanley 1099s unless you have an investment company, but we're not waiting for Trust K1s. The business returns can often be ready to be worked on as soon as you have the December bank accounts reconciled and your loan accounts reconciled. So that's one of our goals, and I think it's a goal of a lot of CPA firms, is let's get these business returns in and out, because most of the businesses are flow-through entities, right? Partnerships or S-corps, and even if you're a sole proprietorship, depending on how big your business transactions are, sometimes we want to start working on that before you even have the rest of your tax return ready, because as a sole proprietor, you're filing a Schedule C within the 1040. So we'll get into some planning ideas next, and those are great conversations to start having with your preparers now. I'm just going to touch on them, and I can answer questions, but I just want you to know that they're out there, and you'll know which ones might pertain to you, and you can jot them down and then have those discussions with your preparers if you feel like you need them. I'm assuming that a lot of us are QuickBooks users. Whether you give a backup copy of QuickBooks to your preparer or you're just printing out the statements that they ask for, however you're dealing with that, it's always a good practice to get in the habit of writing those good descriptions down, especially for certain categories that you get asked about year after year. What did you have for fixed assets or repairs and maintenance, or what makes up the detail of these tax expense accounts? Instead of having to dig up an invoice later, if it's clearly written, this was a computer and 2 pieces of software, that kind of just answers the question. So we have some clients go through and look at those accounts now and jot descriptions down so that they're prepared to give those answers, or the answers are already there when we're starting to look at the return in February or March, whenever we're working on the return.
Are you talking about put on a special account or just have a memo on it saying?
Just on the memo line, yeah, and not for everything. If you're going to Baker Lumber and you're buying lumber all the time because you're building something out of lumber, that's obviously just a lumber purchase. But we all have those accounts that the accountants want to know the details of. What's in your meals and entertainment? What makes up this repair and maintenance? Because it's kind of large this year. They want to know because they want to know if there's something that you need to capitalize. So if you just have a description in the memo area, then that answers the question for them. It's just one thing. Also, if you're using QuickBooks, you can print out a year-to-date income statement now. What does my year-to-date look like now compared to what did it look like at this time last year? And that's one way to know, is your income up? Is your expenses down? Kind of like what Doug was saying. And that's a good thing to alert your preparer to. Because nowadays, in the tax planning area, it's bracket management more so. It used to always be defer. Now there are actually times when you do want to shift income maybe into this year because you want to fill a certain bracket up. So it's just a good idea. Look at where you were last year. QuickBooks easily lets you do that, where you are this year, and note those differences, maybe pass it on to your preparer. Business mileage logs, I just bring this up because if you have business miles, it's one of those things that you have to provide to your preparer, but it's not like part of your QuickBooks file. It's something that you prepare outside of that. And to be honest, the IRS says that those business mileage logs need to be contemporaneous and they can't be estimates. So if you're saying, okay, yeah, I had 10,000 business miles And you know in your head, it's probably more than that, but I can easily recreate a 10,000 mileage log. Using estimates is a red flag for the IRS. And upon audit, they've been known to just throw it all out. They don't let you go back and recreate and prove that the 10,000 miles was accurate. Technically, depends on what kind of agent you get, but technically, they want those business miles to be accurate, not estimates, and contemporaneous, so you need to know what they are at the end of the year.
Monthly, weekly, daily?
You don't need to provide it monthly, weekly, daily for the preparer. For me, I just need to know what the number is. If you got audited by the IRS and they wanted to see that, it would be daily. Yeah. And there are, there are apps that help you keep track of it. And, as preparers, we have kind of little tricks to help you too. Yes?
Yeah, I mean, what I do to keep track of that is I have a clipboard with a simple little form, start mileage, end mileage, date, and explanation.
Yeah.
And that is pretty easy, and I normally remember to write down my mileage on that.
Yeah.
And then I enter it into QuickBooks, so it can be, printed out quickly and easily.
Okay, yeah, I'm not familiar with the QuickBooks feature, but that sounds great. I mean, it's one of those things that we ask for, and you don't want to be doing it in March. You don't want to be looking back and trying to create that number. So that's why I bring it up. I know it's a headache for all of you, and it's a headache for all of us, but that's technically what the IRS wants. And then the other thing that's coming up right around the corner is the 1099 filings. Those have to be done in January. You have to provide those to the recipients on, February 2nd this year, and then, file those forms with the IRS too. So take a look at who those recipients might be. Make sure you have their EIN numbers, addresses, and if you're not going to be, if you know you're not going to be paying anybody anything more, you can start getting that data ready for either you who do it or the preparers who do it. Okay, so now here are some of the discussion items that you can have with your preparer. Doug mentioned retirement plans for small businesses. It's not too late to set one up if you don't have one set up already. Okay, the SEP plan is a pretty simple plan, but that can be established as of the day that you file your tax return, including extensions. Okay, so if you have to extend your return all the way to October, you can still set up a SEP plan for 2015, even though you're going to be filing your return in 2016, and you can fund it then too, because you can't make these retirement plan contributions until you know what the net income of the business is. Simple plans, those are passed for setting up for 2015, because that establishment date is October 1st, but you still might have one that you've set up for a different time. And then the one that we see most often, and if cash flow allows, are these solo 401k plans. Solo means that you don't have any employees. You can have a 401k plan, obviously, if you have employees. That's a different vehicle. This is just if you're a sole proprietor or LLC owner and you have no employees. The solo 401k allows you to put the most away if the cash flow allows, and your goal is to put as much as you can into a retirement plan. The deadline for setting that up is December 31. So that's, if you wanted to set one up for 15, you'd have to make that decision pretty soon. You don't have to make the contribution until you file the return, but it has to be established. And they have a Roth option. When you have a solo 401k, you're still wearing two hats. You're the employee of your company, and you're also the employer of your company. And the employee portion of that retirement contribution can be designated to go into a Roth. The employer portion isn't, but for those of us who aren't able to contribute to Roths because our income levels are too high, there's one way to get around that. Okay, accelerated depreciation. These are fixed assets, all right? Every business every now and then has to buy assets, depending on what your business is. Some businesses buy a lot of fixed assets. Others are just like a computer or a desk or whatever here and there. We're waiting for a bill to come out. We've been doing this for several years now, called an extenders bill. Back when the government was having stimulus plans, they increased what's called Section 179, and I'll get into that. They enhanced those limits, and they created bonus depreciation. And at the end of last year, I think it was like December 19th of 2014, they said, okay, we'll extend those one more year. So that doesn't give businesses a lot of time to prepare, because you're going through all of 2014 not thinking that you're going to have the ability to make these accelerated deductions. And we're in that same boat now. Okay, so the accelerated deductions are Section 179 allows you to expense up to $25,000 of assets, okay, something that has a life longer than 1 year that you're going to use in your business, instead of having to depreciate it over 5 years, 7 years. Prior year and in years past, that limit had been enhanced to $500,000. So you could take your $500,000 of purchases and expense it. Because that's a big change for some companies this year, to have a $500,000 deduction, and now you don't. Okay, but it may get extended, and we honestly think that it will, but it has not yet. So the playing field right now is Section 179. If you buy an asset, it has to be depreciated over 5 or 7 years. You can make an election to deduct up to $25,000 now. Bonus depreciation, okay, it was 100% at one point, then 50%, it's also been 30%. Last year it was 50%. This year, nothing so far. We expect that that's going to get extended too. It's really hard to take a taxpayer from 50% to nothing. And what that means is if you go out and you bought a new asset, a new wig nut or whatever it is that you need to use in your business, that would allow you to take 50% of the cost and depreciate it and deduct it right away and depreciate the rest. And there's strategies. You in your head, you're kind of like, well, what's the difference? There's strategies for using both. Some states follow 179, but not bonus. And there's other reasons out there why you would use a combination. And that's something that your preparer will certainly help you with. But right now, we're all kind of waiting to see what's going to happen on these. And if you've taken advantage of these high Section 179 limits and high bonus in the past, and you're now going to sell one of those assets that you have claimed those on, there might be some income recapture on that because you don't have any basis left to it because you took that deduction in another year. So we're waiting to see what happens with that. Another part of the stimulus plan that is expired, but we're hoping gets extended, are qualified leasehold improvements. If you make an improvement to your building, typically you have to depreciate that over 39 years, because that's the IRS rule. And part of the stimulus plan that has been out there in the past said, you know what, 15 years, we'll let you do that over 15 years, which is much nicer. But as it is now in 2015, it's back to 39 years. Same thing with retail improvements and restaurant improvements. We've had a lot of clients who have taken advantage of these, but there's a big difference between depreciating something over 15 years and 39 years. And also with that shortened 15-year, some of those improvements were eligible for either the bonus depreciation or Section 179. So we're waiting to see if this is going to come through again for 2015, and we really think it will at some level. When are they going to pass that bill? I'm not really sure. Yes? Congress. Yeah. And, both, I can't speak for both parties. I think both parties want to pass it. It's just what else is in that bill that they're haggling over that's going to slow the process down. But I think that's why most practitioners are pretty certain we're going to see an extension of this.
And what's the history of it? The last several years we've done it last year?
Yeah, last year I think it was literally December 19th that they passed the bill for the extenders. And it's not just this bonus depreciation. There are a ton of things included for individual taxes too. One of the more favorable one is being able to make a charitable contribution from your IRA, which it doesn't have to do with business, but there's a lot more in there than just these business stimulus or stimuli. And it's really not a fair playing field if they do it in December. And what everybody was hoping last year was when they made it in December of 2014, that they would pass the extenders bill for 2 years. All they did was extend it for 14, retro for 14. And they easily could have said, okay, it's retro for 14 and into 15, and that just gives us more time to battle over where we really want to be with these. So that was actually the bigger disappointment last year, was that they didn't tack 15 on automatically, because there's a good chance that the bill that passed, the extenders bill that passes this year, is the same exact thing. We just haven't known what it is. Property distributions. If anybody sold a building, mostly, or a big asset, or did some improvements, this partial disposition is new. It was around last year, but we're still getting used to it as practitioners. If you made an improvement to your roof on a building that you own, okay, and it's a capital improvement, it's a whole new roof. In the past, you'd have to take that roof and depreciate it over 39 years. Meanwhile, the old roof is still sitting on that building that you have in fixed assets that's also being depreciated over 39 years. And so now what the IRS has finally said is, you know what, you can go back to that old building. I mean, none of us have the roof on that old building broken out. You've got an asset saying building. But they say you can find some reasonable method of saying, okay, X% of that purchase was related to this roof, and so therefore X% of the accumulated depreciation is related to that roof, and now you can write that off and then just carry on with depreciating this new roof. In some situations, it's not going to be worth it, depending on how old that building is, but it's nice to have it there. And one of the other nice things that happens in that process is you're getting rid of some accumulated depreciation by writing off that old roof and getting that accumulated depreciation off the books. Later on, when you sell that building, there's less depreciation recapture. So I don't really need to go into that here, but it's something that your preparer can talk to you about. So even if the write-off isn't very big because that old roof was pretty fully depreciated, there might be some advantage to doing that process anyway, just to get some of that old accumulated depreciation off the books. And there's nothing new in the world of like-kind exchanges, but if you sold a building or a truck or some kind of asset, there is the opportunity to do like-kind exchange. Unfortunately, there's time limits on it. You have to identify the new property within 45 days. So if you did this transaction early in the year, it might be too late. But it's something to think about if it's coming up in the future. These de minimis safe harbor elections that I want to bring up, they were around last year too. We made the first one, at least for every taxpayer. Okay, what that is saying is, the IRS says, okay, if you buy an asset that has a life longer than 1 year, and that asset was under $500, you can just expense it, okay? And so if you buy a new desk and it's $450, you can just expense it. You don't have to put it on your depreciation schedule and depreciate it over 7 years. In which case you'd probably just take Section 179 on and expense it anyway, but that's just a nice feature. So you can go back through your QuickBooks records and see if you have any of these. You do have to make the election on the return annually. Like I said, we pretty much did it for every taxpayer unless they specifically didn't want it. And the nice thing too is all those items under 500 don't count towards your Section 179 limit. So after you've gotten all of those out and you've expensed them, then you can look at, okay, did I buy anything over $500 and are any of those assets eligible for Section 179? And take up to 25,000 of those and ignore the ones that are under 500. And then the other election is if you have buildings that you own the IRS is saying, okay, if you make repairs and maintenance on that building, and those repairs and maintenance are under $10,000, you might be able to just expense it instead of capitalize it. So you have to have a building that is $1 million or less in cost. So you bought it for $700,000 and you've done $100,000 worth of improvements over the year. Don't look at the depreciation that you've taken. Under this rule, the cost of that building is $800,000. It's under the million. So then you can say, okay, with that building, it's on a per building basis. With that building, what were the repair and maintenance that I had to do, improvements that I had to do? And if they fall under this threshold of $10,000 or 2% of the cost, then the lesser of, then you can just expense that. So if you have a building that meets, you have a building that cost under $1 million and you have a building that was over $1 million, you can still do it for this building, but you can't do it for this building. Or if you have two buildings and both of them are under $1 million, so you can look at this if anybody's in the apartment rental business, or if you have two buildings that are under the $1 million, and this one had improvements that were under $10,000, but this one had improvements that were over $10,000, you can make the election and expense it on this building, and then look, okay, of these improvements, which of these do I have to capitalize? So that one we obviously don't make with everybody, because if you don't have a building, it doesn't really matter. We make that on an ad-needed basis. But that was a tax favor friendly election that the IRS came out with.
When it says for 2% of the cost, so if it's a $10,000 repair, you can only take 2% of it?
No, 2% of the cost of the building, sorry. Yeah, so basically if your building is under, if the cost of your building is under what, 500,000, you might not get the full 10 grand, you'll get 2% of that cost. So if the cost of your building was 400,000, 2% of that is 8,000. So you wouldn't get the 10,000, but you'd get the 8,000, the lesser of the two. And those are annual elections. There's some new implications with the Affordable Care Act in 2015. I don't think that they're going to affect many people in this room. There's reporting requirements if employers have over 50 employees, and there's a shared responsibility payment for employers with employers who have over 100 employees. The shared responsibility payment is something that the IRS actually comes to you and says, here's what you owe. So it has nothing to do with tax reporting for my purposes. I'm not really going to get into those because, again, I don't think it qualifies, but it's something new. Home office deductions. Many of us probably have a home office. The rules are still the same, that it has to be exclusively and regularly used for business. But now they have a safe harbor, and this isn't new for 15, it was around last year too. But I think people are starting to get used to it. And the safe harbor says you can just use $5 per square foot, so up to 300 square feet. So the maximum deduction that you're going to get is $1,500, right, for a home office. But it gets rid of all the record keeping. So you just take this flat deduction. The advantage is if it meets your situation. The advantages are there's no depreciation. So when you later sell your house, you've got no depreciation recapture on having a home office. And normally, if you were doing a home office deduction before, this gets into some of what Doug was saying about splitting your mortgage interest and real estate taxes. Some of those mortgage interest and real estate taxes would be allocated to the business home office, and the remainder would go on Schedule A as an itemized deduction. If you make the election to do the safe harbor, 100% of the real estate taxes and mortgage interest stays on Schedule A. So you don't have to pro rata them out at all. So there are taxpayers where this is meant to be taxpayer friendly, and it's great for some, not for everybody. It depends on your personal situation, but it is out there and something that you can be thinking about now. I think this might be my last thought, is hiring your child. Okay, if you have a child who's capable of giving some benefit to your business, filing, scanning, QuickBooks, I mean, scheduling, there's got to be a business purpose for having them provide work. But if you're hiring your child through your sole proprietorship or through a partnership where the other partner in your business is your spouse, so you're both parents of this child, then the wages that you pay to your child aren't going to be subject to payroll taxes. There's no Social Security, no Medicare, and no federal unemployment. You can still hire your child if you're not operating under one of those entities. You can hire them, if you're an S Corp or C Corp, or in a partnership with somebody who's not your spouse. You can still hire your child. You're not going to be exempt from the payroll taxes. You're going to have to impose the payroll taxes on those wages. But what I see a lot of people do who have the ability to hire and use their children is they pay them, and then they can take the wages that they pay their child and put it into a Roth, because now that child has earned income to start some kind of retirement plan at, a very young age. It works for some, huh?
Define child.
Well, here I'm talking about someone under 18. Under 18, if they're under 18, then they can avoid the payroll taxes. If they're under 21, then they aren't going to be subject to the federal unemployment taxes. If they're over that age, they're just your employee, and so you can the exception for the payroll taxes is for 18 and under. I had one last slide, just talk about entity structures. I know for time purposes, we don't have a lot to get into because we have some questions and answers. For not for this filing season, but for next filing season, they're changing the deadline of some of these, partly to get some of the workflow that Doug and I have been talking about, like get our businesses in and done early. They're going to change these businesses that issue K-1s to their owners, the partnerships and the S Corps. They're going to have the deadline, they're going to move that deadline up to March 15th. That's already there for S Corps, but they're going to have the partnerships there too. Because technically right now, if you're in a partnership, that partnership doesn't have to give you the tax information that you need on your personal return until April 15th, which is when your tax return is done. So they're just trying to move up the dates. It's not going to be for this filing season, it's for next, but it's just a good habit to getting those business information ready early, because even the IRS is going to be pushing for that. Does anybody have any questions? I tried to cram a lot in and just touch on bases. But does anybody have any questions, or for me or Doug or Ledyard? Yes.
Cash. Can you speak to that? You spoke to business mileage. Petty cash, first 6 years we were in business, I kept it right down to
Yeah.
reimburse myself.
Yeah.
I'm a little more lazy, I'm not outrageous, but is that a concern?
No, I mean, obviously, if you're using cash outside of the business, right? So if you're at Staples and you've got $20 in your pocket and you need to buy the stapler or whatever, keep that receipt and the business will reimburse you for it. Is that the kind of petty cash that you have to keep track of all those receipts? Upon audit, okay, what's required to prepare a tax return, from our standpoint, what we need for data is a little different from what the IRS would require upon audit. Upon audit, the IRS is going to want to see the receipt for the stapler, or you're going to be denied the deduction. So receipts are key. I don't need to see the receipt, and most preparers. I can't speak for all preparers. So in that case, you're going to take all your petty cash and categorize what the expenses were and incorporate that into your. If you're using QuickBooks, you can incorporate it that way, or provide here's detail of my out-of-pocket expenses.
Oh, so you should actually keep track of actually what you spent into.
Yes, if you can. Yes, that's great. Yeah. And I don't know. And your preparer can help you come up with a strategy for the best way to do that. I know how I do it one way with my husband's books, and I know I do it a couple of different ways with some other clients. It depends on the volume of that transaction, but if they're business expenses, you definitely want to account for them and get the deduction for them on the return. And it's just record keeping. Yeah.
Well, if I'm keeping as well,
Okay, so I think you asked if you're going to Staples and you're using it on a credit card.
Yes.
Okay. I get asked this a lot. Technically, the IRS would want to see a receipt for what that purchase was, because you could have gone to Staples and, you know, bought some school supplies for your kid. I haven't run into an auditor here that I deal with that gets really particular about that. But that's, they want receipts. Yeah. And in this paperless world, I don't know of any off the top of my head. I'm not really in the business of keeping the records. I do other things with them. I create the returns and stuff. But I think that there are probably apps out there. I have clients who send me receipts that are things that they've just scanned in with their phone, and they just store it, you know, and I don't know what, in some database on their phone, and it's there if they ever need it. I don't know if they organize it that much, but it's there. And I mean, they might have some really great strategies. I personally don't, and there's probably people in my office who do. Yeah.
Expensify in Evernote.
Expensify in I'm familiar with Evernote, but not.
It's a third-party app that works well with QuickBooks,
Yeah.
and it's made for that express purpose. So it's-
Right, right. And so I probably have some people who are using that. And it's a good thing for me to know and be able to provide for my clients. But I think you want the podium back?